$90. Silver just hit $90 an ounce. And the move that just ignited this rally, the move that took silver from the low 70s all the way through 90 in a time frame that has left most retail investors scrambling to understand what just happened, did not come from the Federal Reserve. It did not come from the COMEX delivery situation. It did not come from the Iran deal or the Warsh confirmation or any of the Western financial catalysts that most silver analysts have been focused on. It came from China. And what China just did, quietly, strategically, with the kind of deliberate institutional precision that only a sovereign economic power operating on a decade-long planning horizon can execute, is not just the catalyst for today's rally. It is the signal that the silver market has been waiting for that transforms everything we have been building toward on this channel from structural thesis into active price reality. $90 silver is not the destination. It is the ignition point. And understanding exactly what China just did and exactly why it changes the entire silver price trajectory from here is what this video is about right now. Let's establish the full context of today's move before we get into China's specific action, because the price action of $90 silver does not exist in a vacuum. It exists against the backdrop of everything that has been accumulating in this market for months. We have documented in exhaustive detail across multiple videos the COMEX registered inventory situation. 76 million ounces of physical silver backing, 575 million ounces of paper claims, at a coverage ratio of 13.4%. We have tracked the 6 consecutive annual supply deficits that have consumed 762 million ounces from above-ground stockpiles since 2021. We have analyzed the Iran deal and its removal of the inflation trap that was suppressing silver. We have broken down the Kevin Warsh Federal Reserve transition and what it means for real interest rates and silver's monetary demand. We have covered the CFTC chairman's congressional endorsement of the Silver Act and what official government acknowledgement of structural market problems means for the credibility of the structural bull thesis. All of that analysis, all of those building blocks, were the dry wood. China just struck the match. And the rally that is igniting right now through $90 is what happens when structural fundamentals that have been building pressure for months finally get a catalyst powerful enough to release that pressure in a single directional surge. Please hit that like button and subscribe to this channel right now, because this community gets the analysis first and gets it right. And today is exactly the kind of moment this channel was built for. So what exactly did China do? Let's be precise, because precision is everything when a move of this magnitude is happening in real time. And the noise level in financial media is at maximum. China's shock move has multiple dimensions that are individually significant and collectively explosive for silver. The first dimension is a formal announcement from Beijing of a strategic silver reserve accumulation program, a state-level commitment to build sovereign silver stockpiles as part of China's broader critical mineral security strategy. This is not a rumor. This is not speculation from a newsletter. This is a formal policy announcement from Chinese government authorities acknowledging that silver, given its critical role in solar manufacturing, EV production, semiconductor fabrication, and military electronics, represents a strategic material that China's national security requires be held in sovereign reserve at levels that do not currently exist. The implications of a sovereign silver reserve program from the world's largest silver consumer are almost impossible to overstate. China consumes more silver than any other nation on Earth. China is also the world's largest manufacturer of the products that require silver most urgently: solar panels, electric vehicles, semiconductors, consumer electronics. A formal state-level decision to accumulate silver reserves means Chinese government buying is now competing directly with Chinese industrial buying for a supply pool that was already running a 46 million ounce annual deficit before Beijing entered the market as a strategic buyer. That competition, sovereign accumulation demand layered on top of already record industrial demand, is the most powerful single demand shock the silver market has ever faced. The second dimension of China's shock move goes deeper and is in some ways more structurally significant than the reserve accumulation announcement itself. Beijing simultaneously announced restrictions on silver exports, a formal policy limiting the outflow of refined silver from China to international markets. China is a significant silver producer. Chinese domestic silver mining and refining contributes meaningfully to global above-ground silver supply. When that supply was flowing freely to international markets, to London, to COMEX, to wherever global demand required it, it provided a marginal supply buffer that helped prevent the global supply deficit from becoming even more acute than the Silver Institute's already alarming numbers reflect. That buffer is now being reduced by official policy. Chinese refined silver that previously might have found its way into LBMA vaults or COMEX registered inventory to help backstop the paper futures market is now being retained domestically. both to supply China's own industrial demand and to build the sovereign reserves that Beijing just announced. The simultaneous compression of supply and expansion of demand from the world's largest silver-consuming nation is the textbook definition of a supply shock. And it is hitting a global silver market that was already operating with no margin for error, with 76 million ounces of COMEX registered silver, with physical premiums already running double historical averages, with London lease rates that have recently spiked to extraordinary levels. There is no slack in the system to absorb a Chinese supply shock. There is no reserve capacity sitting idle waiting to be mobilized. The shock hits a system that was already at its limit, and the price does exactly what the price must do when demand surges and supply is simultaneously constrained. It goes up, rapidly, significantly. And the move through $90 is the opening expression of that arithmetic. Let's talk about the Shanghai Futures Exchange dimension of China's move, because the cross-market dynamics between SHFE and COMEX are where the most immediately tradable implications live for Western silver investors. We have covered the Shanghai morning gap signal extensively on this channel. The way in which the overnight SHFE session provides real-time intelligence about Chinese physical demand that Western investors can read before the New York Open. What is happening on the SHFE right now, in the immediate aftermath of China's reserve accumulation and export restriction announcements, is the most dramatic expression of that signal we have seen since silver's January all-time high. SHFE silver is trading at a premium to COMEX that reflects the new reality of Chinese silver economics, a domestic market where sovereign buying and restricted exports mean that silver available inside China is worth more than silver available outside China, and where the arbitrage flows that previously helped equalize the two markets are now running in the wrong direction for COMEX supply relief. The SHFE premium to COMEX is not a temporary anomaly that arbitrage will quickly correct. It is the new pricing reality of a bifurcated global silver market, where the world's largest demand center has formally declared that its silver needs take priority over international market supply. That bifurcation is enormously bullish for global silver prices because it tells every other market participant, every industrial silver user in Europe and Japan, in South Korea and the United States, that the supply they previously competed for with Chinese buyers is now even more constrained than it was yesterday. They must pay more to secure the silver they need. And the COMEX price, the global benchmark, adjusts upward to reflect that new competitive reality. Here is the dimension of China's shock move that most Western analysts are going to miss entirely because it requires understanding Beijing's strategic planning framework rather than just reacting to the immediate policy announcement. China's decision to build sovereign silver reserves is not an impulsive reaction to current market conditions. It is the execution of a strategic plan that has been developing for years, one that is directly connected to China's broader critical mineral security doctrine and its assessment of where global supply chains for strategic industrial materials are most vulnerable. China has already executed this playbook with other critical materials, rare earth elements, lithium, cobalt. In each case, China identified a material critical to its industrial and military future, assessed the global supply chain vulnerabilities, and took systematic steps to secure domestic supply and accumulate strategic reserves before the rest of the world fully recognized the material's strategic importance. Silver is the latest material to receive this treatment, and the timing of the announcement coming at a moment when silver's global supply deficit has been running for 6 consecutive years, and when the COMEX delivery system is showing documented stress, suggests that Beijing has been watching the structural silver situation carefully and has concluded that now, before a major repricing event makes accumulation dramatically more expensive, is the optimal moment to execute the reserve building strategy. China's sovereign wealth and the scale of resources it can deploy for strategic material accumulation makes it a buyer of a completely different category than any private market participant. When Beijing decides to build silver reserves, it does not send a memo to the market asking what a reasonable price would be. It buys. At scale? Consistently. Until the reserve target is met. The buying does not stop because the price goes up. If anything, rising prices create urgency to complete accumulation before costs increase further. Let's now talk about what $90 silver means for the specific market dynamics we have been tracking. The COMEX coverage ratio, the physical premium situation, the eligible to registered conversion question, because China's shock move changes the calculus on all of these simultaneously. The COMEX coverage ratio at 13.4% was already dangerously thin before China announced its reserve program and export restrictions. The new reality is that one of the primary potential sources of supply that could have relieved COMEX delivery stress, Chinese refined silver flowing through the arbitrage channel from SHFE to COMEX, is now formally restricted by government policy. The eligible silver holders who were already refusing to convert at prices below $90 are now looking at a world where the largest buyer of silver just declared its intention to accumulate at sovereign scale and restrict exports simultaneously. Their rational response is not to suddenly become more willing to convert their eligible silver to registered status at $90. Their rational response is to hold even more firmly for a higher price, because the demand signal that just arrived from Beijing tells them unambiguously that the price is going higher. Every day that China's reserve program is buying, and every day that Chinese export restrictions reduce available supply, is another day that the fundamental argument for converting eligible silver to registered silver at current prices weakens rather than strengthens. The COMEX coverage ratio does not improve in this environment. It deteriorates. And the deterioration of the coverage ratio against the backdrop of Chinese sovereign buying creates the most acute version of the delivery stress scenario that we have been analyzing as a risk for months. The mining sector response to $90 silver deserves specific attention because it will shape the supply side of the silver equation over the next several years in ways that are both significant and slow. At $90 an ounce, the economics of silver mining are extraordinarily attractive. Primary silver mines that were marginally profitable at $70 become highly profitable at $90. Exploration budgets expand. Development projects that were waiting for better economics get greenlit. Capital flows toward silver mining in ways that will eventually produce new supply. But, and this is the critical but that every silver bull needs to hold in mind, the timeline from investment decision to new production is 5 to 10 years minimum. The mines that $90 silver will eventually incentivize will produce silver in 2030, 2031, 2032, and beyond. In the intervening years, the years immediately ahead, when China's sovereign buying is active, when COMEX delivery stress is building, when 6 consecutive deficits have left above-ground stocks at historically depleted levels, supply cannot respond to price signals. It is physically incapable of responding in the time frame that matters. The price, therefore, has to do the market clearing work that new supply cannot do on any relevant near-term timeline. And the price clearing mechanism in a market where demand is being amplified by sovereign Chinese buying while supply is being restricted by Chinese export policy and cannot be increased by new mining for 5 to 10 years is not a gentle repricing. It is a rapid discovery of the level at which existing supply holders and eligible inventory owners are willing to make their metal available. That level, based on the behavior of institutional holders who have been refusing to convert at $77, based on the scale of Chinese sovereign demand that just entered the market, and based on the total absence of near-term supply response capacity, is considerably above $90. Here is the price framework that the current data supports for where silver goes from the $90 ignition point. The Bank of America $309 target, which we analyzed in detail in our earlier video on the math behind that projection, becomes significantly more near-term relevant when you add Chinese sovereign buying to the demand side of the equation. The Bank of America model was built on ratio compression and industrial demand. It did not incorporate a formal Chinese state reserve accumulation program as a variable, adding sovereign Chinese buying to a model that was already producing $309 targets under more conservative demand assumptions pushes the upper end of the distribution dramatically higher. More immediately, the ratio compression math at current gold prices still implies silver in the $100 to $130 range, even under conservative ratio compression assumptions that stop well short of previous cycle peaks. The coverage ratio deterioration scenario, where COMEX delivery stress forces rapid price discovery, has historically produced moves of 50 to 200% from the stress ignition point in the compressed time frames that delivery crises generate. And the physical premium expansion that China's export restrictions will accelerate means that the gap between paper price and physical reality, which was already running double historical averages, will widen further, creating additional upward pressure on the COMEX benchmark price as the market attempts to reconcile paper and physical valuations. $90 silver is not the top of this move. It is the confirmation that the move has begun. Everything we have been building toward on this channel, the structural deficit analysis, the COMEX coverage ratio tracking, the ratio signal analysis, the real interest rate indicator, the Iran deal removal of the inflation trap, the Warsh transition and its implications for monetary policy, the CFTC's congressional acknowledgement of structural market problems, all of it was the analytical foundation for understanding why silver was undervalued and what the catalyst for its repricing would look like. China's shock move is that catalyst. Sovereign reserve accumulation plus export restrictions from the world's largest silver consumer hitting a market that was already running a 46 million ounce annual deficit with a 13.4% COMEX coverage ratio is not a catalyst that produces a 10% move and then fades. It is the kind of structural demand shock that rewrites the silver market's supply and demand equation for years. The ignition has happened. The question now is not whether the move continues. The question is how fast and how far. And the math, the honest, documented, verifiable math of sovereign demand meeting structural deficit in a market with no supply response capacity, points toward an answer that will shock everyone who was not paying attention to what this channel has been building toward for months. Leave a comment right now and tell us, with China's sovereign silver reserve program now officially confirmed and export restrictions in place, what is your revised silver price target for the next 12 months? We want to know how this community is recalibrating its thesis in real time, because the conversation that happens in these comments when a major catalyst arrives is always the sharpest and most insightful precious metals analysis anywhere online. And if you know a silver investor who has been watching from the sidelines, someone who understood the structural thesis but was waiting for confirmation that the move had truly begun, share this video with them right now. Because $90 silver with Chinese sovereign buying actively in the market is the confirmation they were waiting for. The ignition has happened. We will see you in the next one.